The roller coaster ride of investing. The emotional roller coaster of investing. Have you ever felt like you were riding a roller coaster when investing in the stock market? One day, your account skyrockets, making you feel like you're flying high. But the next day, it plummets, dragging your heart down. The feelings of excitement, anxiety, and sometimes regret are probably familiar to any investor. I'm Jack, a person who has been confused many times between buying and selling decisions in a volatile market. There were times when I was confused, asking the question, how can I reduce risk but still take advantage of profitable opportunities? Today, I will reveal a simple but effective strategy that helped me overcome negative emotions and turn investing into a more stable journey. That strategy is dollar cost averaging, DCA, also known as the time-based price averaging strategy. If you're looking to turn a volatile market into an opportunity, stay with me, because what I'm about to share may change the way you think about investing, the power of consistency. Join me as we explore the stories of John and Mary, two investors with completely different approaches, but the same goal, to grow their savings. John and the hard lessons from the market. John was a new investor with undisguised excitement. He had just come across $10,000 and decided to invest it all in an ETF that his friends recommended. He invested at the peak of the market, and everything looked promising. But then, the unexpected happened. The market suddenly crashed. The value of John's portfolio plummeted in just a few weeks. Fearing a total loss, he panicked and decided to sell all his stocks. The result? He suffered a huge loss and lost confidence in investing. Mary and the smart DCA strategy, meanwhile. Mary, another investor, also had $10,000 to invest. But instead of putting all the money in one go, she chose a smarter strategy. Dollar cost averaging, DCA. Mary divided the money into $1,000 portions, investing regularly each month, regardless of whether the market was up or down. When the market was up, she bought fewer shares. When the market was down, she bought more shares with the same amount of money. After a year, thanks to this consistent strategy, Mary had accumulated more shares than John. Surprisingly, even though the market had not yet returned to its old high, her portfolio had started to generate profits. Lessons from John and Mary. The story of John and Mary clearly illustrates the power of persistence and the DCA strategy in investing. John failed because he let his emotions guide his decisions. He was greedy when prices were high and fearful when prices were low, which is something many other investors are prone to. Mary succeeded because she did not try to pick the top or pick the bottom of the market. Instead, she followed a strategy of investing steadily, allowing her average price to decline as the market corrected. The truth from real data. According to research from Morningstar, investors who apply the DCA strategy tend to have more stable returns over the long term, compared to investing all at once when the market is uncertain. Even during market downturns, those who use DCA have a higher chance of buying low, selling high. Mary's secret. Mary's success comes not only from the DCA strategy, but also from discipline and persistence. Even when the market fluctuates, she remains unaffected by short-term emotions or negative news. Through this story, you can see that investing is not just about money, but also about managing emotions and applying smart strategies. If you ever feel scared or anxious like John, try doing like Mary. Stick with the DCA strategy and let time work for you. Join me in the next part, where I will share how you can apply DCA today to turn investing into a successful journey. Demystifying dollar cost averaging, DCA. Understanding the time-based cost averaging strategy. So what is dollar cost averaging, DCA? That is referred to as a wave riding strategy in investing. Simply put, DCA is the practice of dividing your investment amount into fixed and regular amounts over a certain period of time, regardless of whether the asset price goes up or down. This sounds simple, but its effectiveness has been proven through many periods of market volatility. The basics of DCA. Let's say you have $6,000 to invest in an S&P 500 fund for a year. Instead of putting all your money into it at once, you divide your investment into $500 monthly installments. When the stock price is high, $500 will buy fewer shares. When the stock price is low, the same amount will buy more shares. As a result, you buy stocks at an average price over the entire investment period, instead of trying to pick the top or pick the bottom of the market. Why does DCA work? DCA is popular not only because of its simplicity, but also because it helps investors avoid many common mistakes. Here are the main benefits. 1. Reduced risk. Imagine you invested all your money at the peak of the market. If the market then crashes, you could incur a large loss, that takes years to recover. DCA helps you avoid this risk by spreading out your purchases, minimizing the risk of buying at the peak. 2. Average the purchase price with DCA. Your purchase price will be at the average level over the long term, regardless of whether the market is up or down. This is especially useful in volatile markets where stock prices are volatile. 3. Eliminate emotions. Investors are often driven by emotions, greed when prices are high and fear when prices are low. The DCA strategy requires you to invest with discipline, eliminating the influence of short-term fluctuations and negative news. 4. Easy to implement. Most investment platforms today support automatic investment features. You just need to set up an investment schedule, choose the amount and assets you want to buy, and the system will do the rest. Imagine you invest $500 every month in an S&P 500 fund for 6 months. Here are the details. In the first month, the price is $50, you buy 10 shares. In the second month, the price drops to $45, you buy 11.11 shares. In the third month, the price drops to $40, you buy 12.5 shares. In the fourth month, the price drops to $35, you buy 14.29 shares. In the fifth month, the price recovers to $45, you buy another 11.11 shares. Finally, in the sixth month, the price returns to $50, you buy another 10 shares. In total, after 6 months, you have invested $3,000 and own 69.01 shares. The average price you pay is $43.47 per share, which is lower than the initial price of $50. This is the power of the dollar-cost averaging DCA investment strategy, which helps you minimize risk and take advantage of the opportunity to buy more when the price is low. Common misconceptions about DCA. While DCA is an effective strategy, there are still some misconceptions that investors should be aware of. 1. DCA does not guarantee profits. DCA is not a get-rich-quick strategy. Instead, it helps you minimize risk and optimize your purchases over the long term. 2. DCA is not suitable for all assets. This strategy works best with assets that tend to increase in value over the long term, such as stocks, ETFs, or Bitcoin. With assets that are prone to losing value, such as commodities or currencies, DCA may not be effective. 3. DCA requires patience. To maximize the effectiveness of the DCA strategy, you need time. This is not a strategy for those who want to make short-term profits. How to get started with DCA. If you're interested in DCA, here's how you can get started. 1. Determine how much you can invest. Choose an amount you can invest consistently without affecting your daily expenses. 2. Choose an asset. Look for ETFs, stocks, or cryptocurrencies that have the potential to grow over the long term. 3. Set up an automated investment plan. Most platforms like Fidelity, Vanguard, or Robinhood support this feature. 4. Stick to your strategy, regardless of whether the market is up or down. Stick to your investment plan. DCA, in a real-world research from CNBC, shows that investors who use DCA tend to outperform those who try to pick the top or pick the bottom. Even during the 2008 recession, this strategy helped many investors buy stocks at rock-bottom prices and reap huge profits when the market recovered. Conclusion: dollar-cost averaging is not a magic strategy to make money quickly, but it is a powerful tool to help you invest safely, steadily, and with less stress. If you're looking for a method to reduce risk and grow your assets over the long term, DCA is definitely an option worth considering. Now, let's explore when to use DCA in your investment plan in the next section. The ideal scenarios for dollar-cost averaging, DCA. When to use DCA. Dollar-cost averaging, DCA, is a useful and flexible investment strategy, but its effectiveness depends a lot on each investor's circumstances and goals. Here are some ideal situations to use this strategy, as well as situations where you should consider other options. When to use DCA. 1. You're a new investor. If you're just starting out in the investing world, DCA is a great strategy to get familiar with the market without worrying about timing. Benefits. Helps you take the pressure off of having to make a decision to buy at the right time when the market hits bottom. Avoids common emotional mistakes, like buying high for fear of missing out, or selling when the market is down. Creates a habit of investing regularly, helping you develop a long-term mindset. Real-world example. A Morningstar study found that new investors who use DCA tend to outperform those who try to predict market trends, especially in the first 5 years. 2. You have a stable source of income. DCA is a great choice for people who have a regular monthly income, such as a salary from a job. Benefits. Easily allocate a portion of your monthly income to invest without having to accumulate a large amount of money initially. Helps you better control your personal finances. making investing an indispensable part of your financial plan. Real-life example. Imagine you earn $5,000 per month. If you allocate 10%, $500 to invest regularly in the S&P 500 fund, after 5 years, you will not only have accumulated capital, but also have the ability to receive profits from market growth. 3. You want to minimize risk in volatile markets. Financial markets are often unstable, especially during periods of recession or economic instability. DCA is a great way to mitigate risk during these times. Benefits. Protects your portfolio from sharp swings by spreading out your buying times. Avoids buying at the peak during hot market periods. Real-world example. During the 2008 financial crisis, many investors who used DCA were able to accumulate stocks at the lowest prices. When the market recovered, they made significant profits, while those who invested once at the pre-crisis peak had to wait years to break even. When is DCA not the best choice? DCA is a great strategy, but it is not always appropriate. Here are some situations where you should consider other strategies. 1. Strong bull markets. During periods of strong, steady bull markets, lump sum investing can yield higher returns. Why? When the market is consistently rising, investing regularly will result in you buying fewer shares over time as prices continue to rise. Investing all your money at the beginning allows you to take full advantage of the growth. Real-life example. A Vanguard study found that, in 66% of cases, investing the entire amount at once yields higher returns than DCA when the market is trending up long-term. 2. You have experience and understand the market. If you're an experienced investor who is good at analyzing the market and identifying good buying opportunities, investing in one lump sum may be more optimal. Why? DCA does not allow you to take advantage of short-term opportunities when stock prices fall sharply. This strategy may cause you to miss out on potential profits if you know how to buy the bottom. 3. You need quick profits. DCA is a long-term strategy. If you have short-term goals or need quick profits, other investment strategies such as short-term trading or venture investing may be more suitable, but come with higher risks. How to determine whether you should use DCA? Ask yourself the following questions. 1. What are your investment goals? If you are investing for the long term, such as retirement, DCA is a great option. 2. Do you have a large amount of capital available? If not, DCA allows you to start small. 3. Can you be patient and disciplined? DCA requires you to stick to your plan, even when the market is volatile. Conclusion. When to choose DCA? DCA is an ideal strategy for new investors who want to get acquainted with the market, long-term investors with a stable income stream, conservative investors who want to minimize risk in volatile markets. However, if you are facing a strong bull market or have short-term goals, consider other strategies to optimize your returns. DCA is not only a strategy, but also a way for you to manage your emotions and build sustainable investment habits in the long term. Try to apply and take advantage of the power of persistence to conquer the market. Putting dollar cost averaging (DCA) into action. How to apply the cost averaging strategy. Dollar cost averaging (DCA) is a simple but effective strategy that helps you invest steadily and not be affected by emotions. To successfully apply this strategy, you need to follow the steps below. 1. Choose the right investment assets. The first step in applying DCA is to identify the assets you want to invest in. Assets that are suitable for the DCA strategy often tend to grow in the long term. Stocks. Choose large companies with stable growth potential, for example, Apple, Microsoft, or Google. ETFs, exchange-traded funds, ETFs that track indexes like the S&P 500, are popular choices because of their diversity and stability. Mutual funds. Investing in funds managed by experts is suitable for those who do not have much experience. Cryptocurrencies. If you're interested in digital assets, Bitcoin or Ethereum may be an option, but be aware of the high risk. Tips for choosing assets. Research price history, growth potential, and reviews from experts. Avoid assets that are too volatile if you do not have experience managing risk. 2. Determine the investment amount. Choose a fixed amount that you can invest regularly without affecting your daily essential expenses. For example, if you earn $5,000 per month, set aside 10%, $500 to invest. With this amount, you can accumulate a significant amount in the long term without financial pressure. How to determine a reasonable amount. Consider your monthly income and expenses. Make sure you still have a reserve fund for emergencies. Calculating a specific example. If you invest $500 per month in an S&P 500 fund with an average return of 8% year, After 10 years, you will accumulate nearly $91,000, including interest. 3. Set up an investment schedule. Choosing the investment frequency is an important factor to maintain discipline and optimize the benefits of DCA. Weekly, suitable if you want to make the most of small fluctuations in the market. Monthly, the most popular choice because it easily synchronizes with the income cycle. Quarterly, for those with irregular income. Tips for setting up a schedule. Choose a fixed day of the month to automate your investments. Use investment apps or platforms to schedule regular investments. 4. Be consistent, regardless of whether the market is up or down. The most important thing about DCA is consistency. Don't let short-term market fluctuations sway you. Why be consistent? When the market is down, you will buy more stocks with a fixed amount of money. When the market is up, your portfolio value will increase accordingly. Secrets to maintaining discipline. Don't check asset prices every day. Avoid being influenced by the news. Focus on long-term goals instead of short-term fluctuations. 5. Use an automated investment tool. Most investment platforms today support automated investment features, making it easy for you to implement a DCA strategy. Popular platforms. Fidelity supports periodic investments in ETFs or stocks. Vanguard provides index funds and automation tools. Robinhood, suitable for individual investors who want to invest in stocks or cryptocurrencies. Acorns automatically rounds up purchases and invests the difference into your account. How to set up automation. Select the investment asset. Enter the investment amount and frequency. Confirm to automatically execute each period. Benefits of DCA Automation. 1. Save time. You don't need to manually execute transactions each time. 2. Eliminate emotions. The system will automatically buy, helping you avoid making emotional decisions. 3. Increase discipline. Make sure you invest regularly without interruption. DCA in practice, a smart approach to investing. Imagine you invest $300 per month in an ETF. Let's look at the results in the following table. Month 1, the stock price is $50. With $300, you buy 6 shares. Month 2, the price drops to $40. You buy 7.5 shares, bringing the total to 13.5. Month 3, the price continues to drop to $30. You buy 10 shares, bringing the total to 23.5. Month 4, the stock price increases again to $40. You buy 7.5 more shares for a total of 31 shares. May, the price returns to $50, the same as the beginning. You buy 6 more shares, making a total of 37 shares. After 5 months, you have invested a total of $1,500 and own 37 shares at an average price of only $40.54. What's special is that this price is lower than the initial price of $50. Dollar cost averaging is not only a simple strategy, but also an effective way to build a stable investment portfolio in the long term. By 1. Choosing the right assets. 2. Investing a regular amount. 3. Setting up an automatic investment schedule. 4. Sticking to it even when the market fluctuates. You can turn DCA into a powerful tool to conquer the financial market. Start today and let time work for you. DCA in real life. Real-life examples of dollar cost averaging. To better understand how dollar cost averaging DCA works, let's look at some real-life examples from common investment scenarios. These examples will illustrate how DCA can help you reduce risk and maximize returns over the long term. 1. Investing in the S&P 500 index. Imagine you decide to invest $1,000 per month in an ETF that tracks the S&P 500 index, e.g. SPY. Scenario. January, the price of each share is $400. You buy 2.5 shares. February, the price drops to $350. You buy 2.86 shares. March, the price continues to drop to $300. You buy 3.33 shares. April, price increases to $400. You buy 2.5 shares. May, price increases to $450. You buy 2.22 shares. Result. After 5 months, you have invested a total of $5,000 and accumulated about 13.41 shares. The average price you bought is about $372.78 a share, which is lower than the highest price during this period, $450. Lesson. DCA helps you accumulate stocks at an average price, minimizing risk when the market is volatile. This is an effective way to invest in stable index funds like the S&P 500, especially when you do not know the bottom of the market. 2. Investing in Apple, APL. You are a technology enthusiast and believe in Apple's long-term growth potential. Instead of buying a large number of shares at once, you decide to buy 10 shares of Apple each month. Scenario. January. The price of each share is $150. You buy 10 shares for a total cost of $1,500. February. The price drops to $140. You buy 10 more shares for a total cost of $1,400. March, the price continues to drop to 130. You buy 10 more shares for a total cost of $1,300. April, the price increases to 160. You buy 10 more shares for a total cost of $1,600. May, the price increases to 107. You buy 10 more shares for a total cost of $1,700. Result, after 5 months, you have accumulated 50 Apple shares for a total cost of $7,500. The average price you pay is $150 per share, which is lower than the highest price during this period, $170. Lesson: the DCA strategy not only helps you reduce the pressure of finding the ideal entry point, but also ensures that you accumulate assets steadily even when the stock price fluctuates. Number 3. Investing in Bitcoin, BTC. You are interested in cryptocurrencies and want to invest in Bitcoin, but the cryptocurrency market is famous for its high volatility. To reduce risk, you decide to buy 0.01 every week, regardless of whether the Bitcoin price goes up or down. Scenario: Week 1, Bitcoin price is $40,000. You buy 0.1 for $400. Week 2, price drops to $35,000. You buy 0.1 for $350. Week 3, the price continues to fall to $30,000. You buy 0.01 BTC for $300. Week 4, the price increases to $45,000. You buy 0.01 BTC for $450. Week 5, the price increases to $50,000. You buy 0.01 BTC for $500. Result: after 5 weeks, you have invested a total of $2,000 and own 0.05 BTC. The average price you paid for each BTC is $40,000, which is lower than the highest price during this period, $50,000. Lesson: DCA helps you minimize the impact of strong volatility in the cryptocurrency market, while accumulating Bitcoin steadily. Comparing DCA performance in examples first, if you invest $5,000 in the S&P 500 ETF, you will accumulate 13.41 shares at an average purchase price of $372.78 per share. Next, with Apple stock, an investment of $7,500 gives you 50 shares, corresponding to an average price of just $150 per share. Finally, if you allocate $2,000 to Bitcoin, you will own 0.05 BTC at an average price of $40,000 per Bitcoin. Overall, the DCA strategy not only helps you minimize the risk of price fluctuations, but also builds assets steadily and sustainably. The above examples illustrate how DCA works in real-world scenarios, from stocks to cryptocurrencies. DCA not only helps you reduce risks when the market fluctuates, but also helps you accumulate assets steadily in the long term. Remember, the most important factor to succeed with DCA is perseverance and discipline. Don't let emotions or short-term fluctuations sway you. If you're looking for an effective and sustainable investment strategy, DCA is the perfect choice for you to start your investment journey. The power of patience and discipline. The power of patience and discipline. Dollar cost averaging, DCA, is not a complicated strategy, but it brings surprising results thanks to the power of consistency and long-term. This is an investment method that helps you minimize risks, average your purchase price, and most importantly, helps you gradually achieve your financial goals. DCA, a simple but powerful strategy throughout your investing journey. You will inevitably encounter market fluctuations. Market downturns can make you panic, while sudden price increases can make you greedy. DCA helps you eliminate emotions and focus on your long-term investment plan. Reduce risk by dividing your investment into smaller amounts. You don't have to worry about buying at the highest price. Averaging. You will accumulate assets at an average price, regardless of whether the market is up or down. Build discipline. DCA turns investing into a habit, helping you stay on track with your financial goals. Investing, a marathon, not a sprint. Investing is not a way to get rich quick. It is a long journey that requires perseverance and foresight. Remember, time is your most valuable asset. The biggest returns come from putting your money to work for you over the long term. Discipline is key. The most successful investors are not those who get lucky and predict the market, but those who stick to their plan. Don't wait for the perfect time to start investing, because it doesn't exist. Start today with the money you have and apply the DCA strategy to your financial plan. Choose the right assets. Invest regularly, regardless of market fluctuations. Stay consistent and focus on your long-term goals. Are you ready to start your investing journey? Apply the DCA strategy now and track the results over time. I look forward to hearing your success story and sharing the joy of your first achievements with you. Remember, success doesn't come from complexity, it comes from persistence and discipline. DCA is a powerful tool to help you turn your financial dreams into reality.